When you buy real estate investments, there are all sorts of things you could worry about, including financing, repairs, tenants, and more. But there's really only one thing you should worry about that will either make or break every single deal you do. And that one thing is what I'm going to cover in this video. If you're new here, my name is Carson. You can also call me Coach, and this is a channel all about helping you get out of the financial grind so you can do more of what matters. In 2008, Warren Buffett, a billionaire investor, gave his shareholders a simple piece of advice that also contains the one thing I want to share with you. He said, "Price is what you pay, value is what you get." So the one thing that Warren Buffett worries about, and the one thing that you and I as real estate investors should worry about, is buying value. But what does buying value even mean? Let's take an example where you buy a property for $200,000. The price is clearly $200,000, but the value that you get is all of the economic benefits that you receive over the entire time you own that property. And that is what either makes you a profit or causes you to lose money on that property. So let me explain in more detail what I mean by sharing two stories from my own investing experience. One where I lost money and one where I made money. As a newer investor, you might think that if you just buy properties at the lowest price possible, it can't help but be a good deal. Back in 2007, I thought the same thing. So I bought an older house for a price of $34,500. And just to give you some context, the normal price house in my area in Clemson and Central and the upstate of South Carolina where I was probably about $150,000 to $170,000 at the time. This happened to be in a mill neighborhood. So this is a neighborhood in the South in the early 1900s. There were a lot of textile mills that have all gone out of business now. But around these factories, these textile factories, they would build a lot of houses for the employees of the textile mill. And over time, these became private, and so people owned them. But they were built in the early 1900s, and so many of the neighborhoods have been run down over time, and these houses are really old and haven't been fixed up. So that is one that I happened to buy. But in addition to that price of the property, I was also able to get a good deal on the financing, where the seller agreed to take $1,000 down, and then the balance of what I owed, $33,500, was financed by the seller over time. So I didn't have to go to the bank or come up with my own money to buy the deal. The rent on this property when I first bought it was just under $400 per month, $395 per month. And over time, during the entire time I owned it, it got up to about $550 per month. So if you follow any of my videos on running the numbers, it seems on the surface that this deal has a decent cash flow. It meets what's called the 1% rule, where if you have the rent on the property is about 1% of what you paid for the property, it has a good potential for making cash flow. And so on the surface, it also seemed like the numbers were good. But in reality, when I looked back over the entire time we rented that property, we had a total negative cash flow of $9,000. Now, of course, we had some good years where we made money, but really the thing that got us in the end was this property had a lot of deferred repairs. We spent a lot of money. In some years, we had big negative cash flow, fixing up things like the roof on the property, trees that were overhanging the property we had to cut down before they fell on the property, and just a long list of older deferred maintenance repairs that took a lot of our money. And then in the end, when we went to sell the property, we tried to list it and get at least what we had in the property, but it wasn't possible. The only price we could get from another investor was a price of $22,500. So we actually lost money over time, not only on the rent, but also when we sold the property. Now you might understandably ask the question, why did you lose money after paying a price like that? And the numbers seem good on the front end. So I want to go back to the quote I shared in the beginning from Warren Buffett, "Price is what you pay, value is what you get." And really what it came down to for us, I already mentioned, is an older property. And with older properties, the price you pay isn't the only cost of buying the property. Often the repairs that you need to put into that property could exceed the cost of you actually purchasing the property from the seller. And that was definitely the case here. We did some repairs just to make it clean and safe and habitable for our tenants, but there were a lot of other things we could have done to the property to make it even better. The siding on the property, there's no insulation in the walls. You could have replaced the windows and on and on and on to bring it up to the standards of a modern house. Now that was part one, and I already mentioned that was a problem. But really the bigger problem, we've made money on older houses in the past, but the problem was the location. If we were to put a lot of money into this property, this was on a street where other people were dealing drugs, where there were some vicious dogs, right down the street from us, that for any tenant who came to our house to look at it had to drive by, people sitting on the front porch staring at them and kind of intimidating them. So just the location was not great. And so that is probably the cardinal sin of real estate. You've heard location, location, location. But if you're looking for value in real estate, location is always the place that you start. And I'm going to have a little bit more to say about that later on in the video. But for now, I want to show you an opposite example, a property that I bought where I actually paid what seemed like a higher price at the time, but where I actually made money over time. For the second example, I bought an older single-family house back in 2009. So it wasn't too long after the first example. I paid a price of $130,000. But as you've learned now from the other example, when you buy an older house, the price you pay isn't your total cost of buying that property. So in this case, we had another $40,000 that we spent in remodeling the house. We actually did a pretty big remodel where we replaced all the wiring, the plumbing, new heating and air, new sheetrock in the house, a new kitchen, remodeled the bathrooms. So it was a very new house when we got done with it. But when we total up all of our investment, we bought it for $130,000, put about $40,000 into the property. We had about $170,000 invested. In the context at the time, when I look back at the value of that property, it was probably only worth about $160,000 to maybe $170,000 at the time. So we definitely did not buy this property at a big discount. And the way we bought this property and financed it was actually very similar to our other deal. We negotiated with the seller and we paid $4,000 down. And then the balance of what we owed the seller was $126,000. And the seller agreed to let us make him payments over time. In this case, we paid $400 per month, which was a nice low monthly payment so that we could actually rent the property out and make a positive cash flow. And even better though, every one of those payments went 100% towards principal. So we had a 0% interest rate that we negotiated as well. So sometimes what we found is that you can get a low price in some cases. In other cases, we paid what was probably a higher price, but we negotiated really good terms with the seller on the financing of the property. Now, negotiating seller financing and what all the implications are and the terms of that seller financing is another story for another video that if you're interested in, let me know in the comments below, and I'd be happy to dig into that deal and give you even more examples of how that works. But with this deal, at the time that we bought it back in 2009, the rent would have been about $950 per month. But the full story was that we actually moved into the property, my wife and I did. And if you know my story, we used to live in a fourplex, so we were house hacking at the time. And we enjoyed living in the fourplex, but we decided to start a family and expand a little bit. So we kept the fourplex and rented that out. And this is the house that we moved up to. So we decided to move into it. But if we had rented it out, it would have been $950 per month, which if you run the numbers, like I talked about in the other deal, this would not have met the 1% rule. To meet the 1% rule, we needed to be about $1,700 a month in rent. We were at $950. So on the surface, again, just from those rough ways of analyzing deals, this was not a great deal on the front end. But over time, and if we fast forward to 2022, we now have a rent of about $1,550 per month. That's what it's currently rented for. But if we put it on the market and had an open market rent, because we've had a tenant there for a couple of years, we probably could get about $1,600, maybe $1,650. So over time, the rent has gone up. And really the bottom line for us on this deal is that not only has the rent been going up, we've been making a positive cash flow along the way. So because the rents have gone up and because our mortgage payment, which is our biggest expense, has stayed the same over time, we now make about a $500 to $600 per month cash flow. And so over time, we've had a positive cash flow on this property. And then on the value side, it started off at $170,000, maybe $160,000 in value. Today, the value is probably $230,000, maybe $250,000 if we were to sell the property. So although this wasn't a home run real estate deal in the beginning, over time, it's one that's going to become a good deal and make us a lot of money. But why? Why did this deal turn out good, whereas the other one didn't? The answer has to do with the value that we received for the price that we paid. There are actually 3 really important lessons that I learned from these 2 deals, and I want to share them with you right now so that you can learn to find and maybe add value to the deals that you buy. The first lesson that I learned about buying investment real estate that's going to add value over time is that you need to buy in a location that's in demand. That just means that people want to live there. And that's one of my favorite things about investing in real estate. It's not rocket science to figure this out. You've lived in places either as a rental property or as if you're owning a property, and you know the reasons why you want to live in a neighborhood or maybe why you don't want to live in other neighborhoods. And so in your local town, you just need to make a list of what those things are. It might be in a suburban area that is a school district. It might be convenient to shopping. If you're in a more urban area, it might be because it's near a park or it's walkable to a really great coffee shop or commercial district. It might be there's a walking and biking path nearby. Those are all legitimate reasons why it might be in demand. And I had a teacher early in my career named Greg Pinio who gave a really great term that can kind of be an all-encompassing thing to help you find local streets and pockets of areas that have great demand for real estate. And he called it romance. Romance means it has emotional appeal. And sometimes you just have to get on the street level and go street by street to figure it out. So my two examples, my first property did not have romance. It had barking dogs that you were afraid were going to break the chain and attack you. It had drug dealers down the street glaring at you and is intimidating. Those things are the opposite of why people want to live there. People live there because they have to, and it's a whole another problem on how do we solve these kind of issues. But buying investment property in that location can be really tough because you can't control the next door neighbor and what they do with their dog, what they do in their spare time. So that was an example of a bad in-demand location. My other property, on the other hand, was in demand. It was close to the university. It was walkable to a botanical garden, had quieter, older streets that just felt a little bit more appealing. You could walk your dog or push the stroller in our case and have a really good walk around the neighborhood. So in demand, people want to live there, and that's made it very easy for me to rent the property. And if I wanted to, it'd make it very easy to sell it as well. The second lesson I learned about buying investment real estate that adds value to you over time is buying in existing or what's called infill subdivisions. Now, in lesson number 1, I talked a lot about demand, but the other side of economics is supply. And what I learned sort of by accident with my second deal was that when you buy in older infill subdivisions, you're actually building in a barrier for yourself. Your supply is limited because it's not as easy for new construction for builders to come in and build a lot of houses right next to you. So in an older subdivision, most of the lots are already built out. There might be one or two here and there, and usually not the best lots. And so the existing houses there, as long as they're in an in-demand location, have very little competition. There aren't going to be other lots and new construction houses coming in right away. So that's one advantage. Your lot is going to tend to go up over time as long as that demand keeps up. But it's also interesting. I've been looking at construction and comparing my property to new construction properties over time. And what I've noticed is that when I first bought the property, remember I had $170,000 in it. And let's just say that the lot was worth $40,000. It was 2009. People weren't buying a lot of lots. But out of my purchase of $170,000 and my remodel, let's say $40,000 was land, so the other $130,000 was construction cost. So that comes out to about $87 per square foot is what the cost of my building was. If a builder had torn my house down at that time, they could find a lot just like mine, and they bought it for $40,000, they would have had to build a property probably about $120 per square foot. So their very same square footage was about 1,500 square feet was my house. It would cost about $180,000 for that builder to deliver that property to a buyer. So that's about $220,000 total, $40,000 lot plus $180,000 in construction cost. So even in the very beginning, my existing remodeled house had a competitive advantage. I was in it for $170,000. A new builder would have to build it for about $220,000 and sell it to their buyer for that price. So that gives me a competitive advantage even in the beginning. But look what happens over time. If you fast forward to 2022, lots are even more rare in that area because they've been built out over time. But let's say somebody could buy that same lot for $100,000 today. That's about what it would probably cost. The cost of construction is more like $200 per square foot. And a lot of that's just the overall economy. There's all sorts of other things that go on with that. But needless to say, a builder, if they could find a lot of my subdivision, could build it, buy it for a $100,000 lot, build it for about $300,000. So they'd have to deliver a house to a new buyer for $400,000. So you can see how that competitive advantage grows and grows over time because you're buying in an existing older subdivision as opposed to on the edge of town where most builders can build big subdivisions. You have an advantage. You're closer to the things people want to be to, the demand stuff, and you have a limited supply. Those two things are a really good recipe for adding value to your investment properties over time. But there's actually one more very important lesson that caused my second property to work out very well as an investment. It actually came down to some very simple math. The property that I owned produced income that was more than the cost of my debt. And I actually had a debt that was a fixed cost over a long period of time. Let me explain that with some numbers so that it makes sense. Remember when I first bought the property, the market rent was $950 per month. And I had approximately $400 per month in operating expenses. Those are things like taxes, insurance, maintenance, paying a manager if I chose to manage the property with a third-party manager. I actually managed it myself, but there are some costs there that anybody's gonna have to pay. So let's just round that off to about $400 per month. So I had $550 per month left over in what's called net operating income. If you watch other videos with me, you know that's one of the most important numbers that you need to know as a rental property investor. And so from my $550 per month in net operating income, you can subtract my $400 seller financing mortgage cost, which meant I had $100 per month approximately in positive cash flow in the very beginning. Now, it's nice that I had positive cash flow, but that's not a great cash flow if it stayed that way over time. But fortunately, remember, because of those other lessons that we learned about having an in-demand location with a limited supply, over time, this rent has gone up to the point now in 2022, the rent's $1,550 per month. And yes, my cost for operating the property, like taxes, insurance, and maintenance, things like that, have also gone up, but I've tracked those pretty closely. It's about $550 per month, maybe even less in a lot of months for me because I self-manage this property, but $550 per month would definitely cover my operating expenses, which means I have about $1,000 per month in net operating income today, so many years later. And I still, though, and here's the big important lesson, I still have a mortgage payment of $400 per month. That's been fixed the entire time. So I have a cash flow today of $1,000 minus $400 or $600 per month. Now I want to show you this and how this dynamic works on a graph. And as you can see here, there's a beautiful cash flow gap that starts really small early on in your investment, but then it grows and grows and grows over time. And it's beautiful because that fixed cost of your debt stays the same over time. You can see that bottom line, but the rent and your net operating income that your property produces goes up incrementally, and it gets bigger and bigger and bigger and adds more value to you as an investment over time. So the value of this third lesson is something called an arbitrage, or the difference between what your rent is after you pay all your expenses and that fixed cost of your debt. So the thing you can do up front, the thing all of you can do today, and a good strategy today, is if you can find properties that are in demand, lesson number one, that have a limited supply, lesson number two, and that have cash flow gaps that you can fix over time so you can make sure that your debt's going to be fixed. Get a 30-year mortgage or some other long-term mortgage. By doing that and combining those three lessons, that is a great recipe for adding long-term value to your real estate investments. So the main takeaway here, price is what you pay, value is what you get. I hope that principle from Warren Buffett makes a lot more sense to you now as a real estate investor. And if you'd like to learn more about how I've built my own wealth and how my own rental properties have added value over time, I think you'll like my next video, which is all about my very first rental property. And I go into a lot of detail and show you graphs and spreadsheets and numbers about the beginning to end over a 17-year period of my very first rental property. And I think it'll give you some insights about how you can buy properties for yourself and how it can make you money over time. You can find that video both with a link above me here somewhere and also a link in the video description below. Thanks for watching. The Coach Carson channel is all about helping you get out of the financial grind so you can do more of what matters. My name is Chad Carson. You can also call me Coach, and I'll see you in the next video.